and welcome into this terrifying edition of Freightonomics. I'm Zach Strickland, here with special guest Ian Walters, Senior Director of Finance at KCH Transportation. He's going to provide a little bit of external world insight for us today, as well as kind of breaking down what we see with the fallout of some of these tariffs. We're not going to get super detailed into the weeds with some of these, what it means, but I want to keep it relatively focused in the transportation and logistics sector, of course, as we have a guest here today. And for those of you that are interested, today, Craig Fuller and myself are going to have our own little tariff special. So without further ado, let's kick things off. Ian, introduce yourself.
Yeah.
Hear a little about you.
Appreciate it. Really happy to be here. Like you said, Ian Walters, Senior Director of Finance over here at KCH Transportation based out of Chattanooga. Have been in the transportation space for, about 7 of the 10 years of my career so far. I've been fortunate enough to work at places like a U.S. Express and at a Repower. Prior to KCH, I was actually at Wabash, so I got to see a little bit of the manufacturing side.
Right.
But now, obviously, back into the operational side. So yeah, super excited to talk, and certainly not an economic expert by any stretch of the imagination, but have a decent grasp on how things kind of like flow across the transportation space too. So really looking forward to the
conversation. And we're not going to ask you to be the economic expert here today. We just really, I think hearing like people that have boots on the ground and you feel some of these impacts. Now it's a little soon to actually know what these tariffs mean. And I think the data is going to show that. So first off, let's kick things off with the market in 2. If you guys want to count me in, in 3, 2, 1. All right. Let's start off with the OTVI. This is the demand indicator. This is going to be the thing that we're going to want to watch the most closely here over the coming months as we see these tariffs roll out and have an influence. It's too early to tell. I think we were watching this index at first to really just see what the stagnation, maybe people were worried. They were in a holding pattern almost. We're trending right in line with the 2023 level, outbound tender volume. And it's almost mirroring it entirely. So not so much volatility on the demand side component as of yet. And I don't think we're actually seeing any of that manifest. Purely, again, erosion has come from a lot of the intermodal pulling some of the trucking demand out. Let's look at the next chart here, the IOTI. This is that upstream indicator. There's a little bit of disconnection here between upstream demand and downstream demand at the moment. A lot of people pulling all this inventory forward. They're cramming it into warehouses. It's getting on the rails, moving in slower transit across the country. Thanks to Mike Baudendistel for his article this week to talk about that. But upstream demand looks really, really strong. By no means do I think that this suggests that economically speaking, downstream, we're going to see this manifest. This is simply a pull forward exacerbation that we're looking at as we're outperforming last year by a significant amount at this point. Let's look at that next chart in the loaded container volumes for the rail. Rail intermodal volumes are trucking along, no pun intended. They are really humming. Year-over-year growth still in play. We've got a little bit of an Easter timing issue here, so don't take that trough as too much concern here. But demand on the rail side looks relatively stable, relatively consistent at this point. Let's finish things off with the last chart. Tender rejection rates. Now, these are surprisingly volatile. We are still seeing elevated tender rejection rates from a year-over-year standpoint. Nothing crazy, but this elevation continues to be over 6%, and we're bouncing around. I think, Ian, and this is where I'd like to get a little bit of your, real-world insight here, as we'll call it. The erraticism in the tender rejection index it's not necessarily showing like a strong turn like we saw in COVID or even in the 2017 environment where we really saw rates take off. We're seeing this percolation, if you will. Like we're seeing these things it settles back down to 5%. Whoops, 6.5% again. Have you felt that manifesting? Have you felt some disturbances in the force, if you will?
I think that's a pretty good way to put it. Honestly, the short answer is yes. We absolutely have seen that, right? I think we've seen We've definitely seen the impacts of that when you think about it at a broad level, but then also thinking about what we're seeing from a volume perspective for KCH. We absolutely saw spot volume opportunities that sort of mirrored that OTR kind of run up that you saw in the back half of March, right? We absolutely saw that. The thing that we're trying to figure out is why is that not really having an impact on rates, right? Which for us, we love the volume, we'll take it. But again, we're trying to figure out when is this going to, turn into a more sustained run that allows, spot rates to actually move up. Because that's kind of the story for March was spot rates were relatively flat,
flat.
Throughout the entire month.
Right.
And so even though you had really this kind of tale of two two halves as far as, how March played out, nothing really materialized, right? And you're like, what's going to happen here? And so we absolutely did see that. And then the other thing that I'll just say, kind of outside of the tender rejections was we absolutely also have seen more and more of our shippers start to push for the intermodal space, right? We're starting to see a lot of that. Again, whether that's going to be kind of a shorter term, more reactionary kind of measure that the shippers are taking relative to this pull forward activity. I think that's, we'll probably figure that out here over the next few weeks.
Right.
But I would also say that's kind of a continuance of a trend that we've seen, since 2023, 2024, broadly speaking, as well. So yeah, we're absolutely seeing that play out, on the operational side too.
Yeah. So, I mean, the tender rejection rate being a little bit disconnected from the spot rate environment, I don't know that it's necessarily surprising from my perspective, because it's not we're kind of hovering in a space of about a 5 to 6.5% rejection rate. That doesn't necessarily mean a flood of freight goes to the spot market.
Correct.
That's like, I'm going to drop down the route guide a little bit further. What we typically see rates spike up is it's when we see these really sharp, dramatic turns and tender rejection rates while these route guides are falling about quickly. And I think we're alluding to this a little bit with the intermodal growth. The sense of urgency for this freight is not there.
Nope.
This is March. This is not Christmas. Do you think that's having an influence?
Yeah, I definitely do. Yeah, I think it is. Because again, we're also, going back to kind of what we're seeing and what we're hearing, right? We're also hearing about, opportunities to provide warehousing solutions, right? And so that's obviously a bit of a difference from an inventory management perspective compared to, real time or just in time inventory management. So this is definitely sort of building up inventories, allowing those to naturally kind of deplete over the course of time. And then they're basically going to reassess again, whether that's a couple months or a couple quarters before they really have to, actually reassess what their strategy is going to be. But yeah, that's definitely what's playing out.
Yeah, let's talk about the warehousing space a little bit. I know that's not necessarily the wheelhouse here, but have the customers been talking about maybe they need more outside of their current environment?
Yeah.
Like their standard warehouse is kind of full. Now they need some temporary warehouse space, or is this more of a like, I need to grow my warehousing?
Yeah, I think it's a little bit of both,
okay.
honestly, right? Because, we deal with a pretty diverse group of shippers overall. And so we absolutely have shippers kind of at the enterprise level that are like, hey, from a regional perspective, I think it makes more sense for us to look to you guys for the warehousing solution, given, you're already servicing the freight. And then we do have some of our, again, so they fall kind of in the SMB space, shippers that are like really looking to us to provide that initial warehousing solution, right? Because this is the first time that they're really dealing with it. So it's very interesting to kind of see how the conversations are happening. I spent a little bit of time talking with Zach Walker, who's our VP of sales, about it and kind of get an understanding of what he's seeing. And he's like, man, it's kind of all over the place, if I'm being honest with you, because people are, again, it's a reactionary environment right now, right?
Well, they've had to be.
Right. What's interesting is it's reactionary. We're being proactive as far as the pull forward goes and all of that, but we're still trying to get everything figured out. And whether this is truly a new normal or if this is a, kind of a 6-month blip and we'll get back to normal here in the back half of the year, right?
Right. Do you think that this, now that we've got, our our tariff announcement, and we're not necessarily going to see some sort of inflationary impact right away.
Mm-hmm.
Do you think that after a couple of months, we actually have some clarity now? Like, as from your business perspective, like now that we have these tariffs in place, there's obviously the possibility that we see some reciprocal tariffs and things like that have to play out. But I don't know that any of those actually have a meaningful impact on our domestic transportation market as much as they do the overall economy. And so I want to split those out a little bit here.
Yeah.
Do you think that from a business perspective, you feel a lot of your customers are going to start kind of, they'll get through this initial pull forward, cramming stuff in to the country and start to actually move forward with things? Or do you think that they're still going to sit back a little bit?
I think that I think they're going to sit back a little bit. I think they're going to wait. I think they're going to see, because I think that, yes, we have the announcement. We have a little bit more clarity. There was obviously a little bit of a display yesterday as far as how it was all announced and whatnot. But I think if you really kind of dive into some of the mechanics of, maybe things like how did we even arrive at the tariff amounts and whatnot,
Right.
It's a little bit indicative of this still feels like a temporary measure, right? This still feels like something where we're open to conversations. We're open to figuring out a more optimal path forward together, and that's what I think that people are just going to kind of wait out and see. Because again, when you really break it down, it just feels like they're not going to be as sticky as maybe they're originally kind of led on to be, and that's where, again, let's wait it out. Let's see if we're still having this conversation in 2 months now that we've officially kind of stamped it. Here's where they are, and if we are, then we probably need to make some longer term decisions.
Yeah, so still a little bit of a holding pattern. I agree with that sentiment in general. Let's start breaking down some of these news stories. I alluded to Mike Bowdendistel's article, and I think a lot of people should read. Internally here at Sonar, we tend to talk internally, and we're so used to it, we're in it. And I was talking to Mike before the show that some of these concepts that we talk about internally, we're so used to it, but the rest of the world, especially those that aren't necessarily in transportation or supply chain management, they're not thinking like intermodal has a little bit of a cost service trade-off.
Yeah.
You talked about your customers saying, we want intermodal. Intermodal isn't slower by itself while it's on the rail. It's just slower in general because of all the processes and transitions that it has to go through to move across the country.
Yeah.
His article basically addresses that and says, look, people are preferring this right now because, like we just talked about, sense of urgency isn't there. Are you hearing customers voice this clearly, or are you just thinking that this is an easier form of transportation in this environment?
What I'll say is not explicitly hearing customers, voice that specifically. But again, I do think that the shift to an intermodal or a flat out rail solution is a continuance of the trend that we've seen over the last kind of 15 to 18 months, broadly speaking, right? I think if we think back to what we were hearing throughout 2024 from the publicly traded companies was that, hey, intermodal volumes are incrementally ticking up a little bit, but we still have, capacity and we can still take on more volumes. And the rails were absolutely saying that too, right? And so I think that, again, that piece, I think that this is just a little bit of a broader shift overall, where, again, I think that also a little bit of recency bias maybe comes into play when we think about 21, 22, and how drastically different it was from an operating environment perspective. Because I think back to, like a 2018, for example, right? Still very much a bull market, still very much up. But didn't have nearly as much. Obviously, it wasn't as long, and didn't have as much going on. And we've seen a shift from rail to intermodal, or from truckload to rail and intermodal since that time.
Let's pull up the chart that Mike uses in there, the container volume chart. This is the white line is going to be the loaded outbound container volume on the rail, and then the yellow line is going to be the long haul trucking tender volumes in yellow. And then the orange one is going to be dry van tender volumes. And you can see that there is I think, starting back in the fall of last year, you can really start to see this divergence of how they were like, you know what, just keep it on the rail.
Yep.
And this is kind of pulling apart. And of course, it costs less in general to ship things intermodal. The trade-off, of course, is not that service component. You know, you got a little bit in there as it transitions through drayage and whatnot. And then the next chart that he pulls up in here, and this is something for the financial sector, as they get concerned about this, they're like, well, they're hauling more volume, they're taking more share, but the pricing component, which is reflected in this chart, is near the floor. So the white line, of course, showing how rates have fallen because intermodal during COVID, as you talked about, they lost a lot of share because the sense of urgency was higher and their infrastructure fell apart. And service was so necessary at that point. That was when shippers were not, you know, they couldn't keep up with demand. So this pricing component is really a hindrance to the intermodal sector right now, because do you think that it's going to sit there until the trucking sector starts to have some momentum?
Well, I think there's a little bit of a lagging effect, right? Of it takes a while for the pricing to actually kind of ramp back up, right? And so if we think about, again, the last 15 to 18 months, we've seen volumes incrementally, increase. Broadly speaking, I would start to think that it will actually mirror kind of truckload rates in the back half of the year, right? Like, I think that just broadly speaking, like, everyone's been bouncing around this bottom, kind of bottom tier market or rate environment for quite some time. I think that it will naturally increase. I do think that however truckload goes is kind of going to be the indicator for that.
How close do you think we are? Like we were talking before the show, but I'd like to get kind of the outside perspective here on, we've had numerous conversations on this show about how we feel we've come through the worst of it from the freight market perspective. We've got this long 2.5 year freight recession-esque style market environment. We can see the fundamentals improving, the demand side kind of not doing as much, but this has been very much a supply side contraction improvement. So there's just less operators available, less competition in the space. That's why one of the reasons we're seeing elevated rejection rates. Spot rates have increased on a very, very slow linear trend line, though not as erratic as a lot of transportation service providers would like. How close do you think this is? I guess the better question is, how vulnerable is this market at this point? Say we get some clarity around the trade stuff and economic demand starts to get better. How close do you think we are to a market kind of being a little bit more volatile?
I think we're actually very close, right? Because if we think about like what we saw within Q1, right? Q1, I think the general sentiment, especially during, the early to mid part of January, was like, okay, this market's actually ready to kind of take off here, right? We saw spot rates absolutely kind of skyrocket, relatively speaking, because of the winter weather dislocation that we saw, right? And then obviously we returned back to some normal seasonality. And then now we've got, again, to the point that you made, we've got the tariff conversation and whatnot that's really having an impact on potential demand or volumes. So throughout the course of that, we have continued to see, authorities or carriers exit and capacity exit the market. So we're much closer to equilibrium right now, even though it doesn't really feel like it, than we were at the beginning of the year, right? And I think, again, once we get that clarity and once we get that understanding, I still think that we're poised for a significantly better second half of the year than the first half of the year. I think the consensus for most people was that we would start to have, what I'll call an exponential run up in rates in starting right around now, right? Like with produce season and the early parts of food and beverage season kind of kicking off. But we don't have that, right? So I still think that there's a pretty good kind of foundation for, the market to absolutely, a term that I'll use kind of loosely, but flip, so to speak. And we actually do have the opportunity for rates to increase. I still think we've got, line of sight to somewhere in the ballpark of about 15% by the end of the year from where we're at right now. And so again, the thing that we really don't want to talk about too much, but we have to is the tariffs.
Right.
So
Yeah, let's dive into that in the last couple of minutes we have. So, we talked about the freight market being close. That was a supply side contraction. Liberation Day, as it's been coined, triggers panic mode for manufacturers. And this is reflected in the data. This has been happening for a couple of months. The ISM, the PMI that came out a couple of days ago, shows that there has been a slowdown in manufacturing. The orders component down in the low 40s. The PMI itself slipped back below expectation by about 50 basis points or so. And, this is kind of the point of the tariffs in Trump's mind is we're going to bring manufacturing back, except, and again, we've got this near-term situation and long-term situation. He's going to make the case that this in the long run will bring manufacturing back, et cetera, et cetera. But in the near term, I don't think there is a person that I have listened to or read that feels bullish about near-term demand-side dynamics. And, it doesn't look like, when you're talking about blanket stuff, I think it was an interesting thing when we were looking at some of this ISM data. If we want to pull up that graphic here, manufacturing at a glance, you can see the pretty much everything's down outside of inventories, which inventories are growing.
Which is obviously not what you want to see from a domestic truckload perspective. So.
Yeah, this inventory is growing, but they're not getting fulfillment.
Correct.
They're just sticking in these warehouses, which is increasingly costly, et cetera. This is essentially what we saw at the end of 2022, where people grew inventories faster than they could bleed them.
Yep. Yeah. Again, I think that this is sort of the one caveat that I would say to my my answer to your question right there is like, at the end of the day, where manufacturing goes is where the domestic truckload, industry goes overall, right? And so the fact that we do see contraction, and honestly pretty meaningful contraction, like we're looking at about 130 basis points month over month overall. And then all of the sort of sub-components that make up that index are also very much contracting at a very meaningful rate. Does not give me, great, confidence in the near term. But again, I think that, once we kind of get some of this stuff figured out, and once we understand what the new normal looks like, that's where we understand what we're operating at from a baseline perspective, and we'll start to just naturally see the market come back again in the back half of the year. My original thought was we would be there in early, Q2. I think that we're probably looking at somewhere in the ballpark of now July or August, right? With maybe some weather-related events that are kind of catalyst there. It's not what we want to talk about really at all, but that's just the reality of the situation.
For sure.
And so, I think that this is, one of the things that I look at closely every single month, because again, it is, tried and true. As manufacturing increases or as it contracts, the truckload market also kind of follows. So.
Yeah, and I want to talk about kind of like the direct and indirect influence of tariffs. Like I think really the majority of these tariffs from the transportation sector's, side of things is it's going to create inflation, which is going to erode consumption, which will translate into a downturn economically, which means there's less freight moving on the roads.
Yep.
I think that's kind of straightforward in the near term. And then, of course, later, everybody builds their factory in America and we're producing. One of the things that I noticed, though, he left Mexico and Canada alone for the moment. So there's going to be some commodities, some commodity discrepancy here in terms of demand flow. Do you have any insight or concern or thoughts around, some of these inequities in certain commodities moving across the United States?
I don't have a ton of concern overall, right? I definitely think that again, it's just one of those things where we just have to continue to watch and see what we're actually seeing.
Right.
We, candidly, we do some cross-border stuff. We don't have a ton of exposure to it though. It's one of the things that we're actively kind of building up. But overall, I don't have grave concerns, so to speak, around anything like that. But it is definitely something that...
Is there a sector that you think is being hit harder than another that you're more concerned about?
I definitely think that you can't discount the impact that automotive is going to see, right? I think that automotive is definitely going to see some headwinds related to it, and kind of the last thing that sector really wants to see after the beating that they've taken over the last couple of years post COVID. So, I definitely think automotive is the one that we have to look at again, from both a Mexico perspective and a Canada perspective too. So.
Yeah, and then by leave alone, I meant that he didn't do anything additional.
Correct. Yeah. Correct. Yeah.
Yesterday, which the 25% tariff still in play, and that still has to be addressed, not implemented yet. He has to hear some sort of reciprocal, effort from their side. I'm not really sure if anybody knows what that means as of yet. It was interesting though to see that essentially what he's done with these tariffs, and Flexport did this brilliantly. They reverse engineered the logic and saw that basically it was the trade imbalance that they're correcting directly across the board. So again, there's still a lot of uncertainty. Ian, thank you for joining us today, and thank you for watching. We will be on later, or I will be on later with Craig Fuller to talk about the tariffs in more detail. And of course,